and welcome to another episode on futures and options. I am Kushal Lodha, founder of KAGR, an education company in financial literacy. And in today's video, we are going to learn leverage in FNO, how to use it safely.
Hi Kushal. Many friends hear the term leverage in trading. But can you explain what it really means in the context of FNO?
Absolutely. Leverage is essentially the ratio of your total exposure to your margin. For example, if you have a trading capital of rupees 1 lakh and you use 10x leverage, you can control a position worth rupees 10 lakhs. This means that even a 1% move in the underlying asset can lead to a 10% gain or loss on your trading capital. So, while you're investing rupees 1 lakh, your profits or losses are based on a much larger portfolio.
That sounds powerful, but also so risky. What are the main advantages and disadvantages of using leverage?
You're right, leverage is a double-edged sword. The advantages include accelerated returns on your base capital, lower capital outflow for higher exposure, and the ability to achieve financial objectives more quickly. However, the disadvantages are significant. If your investment idea goes wrong, leveraging can lead to huge losses and can quickly destroy your entire capital.
Given these risks, what basic strategies should traders keep in mind when using leverage?
First and foremost, understanding margin requirements is extremely crucial. This dictates how much capital you need to open a position. For example, if your broker has a 5% margin requirement, you can control a position worth 20 times your capital. A simpler example can be if your leverage is 30:1, you would need a margin of 3.33%, which is 1 divided by 30 into 100 of the position value you wish to open. Secondly, implementing stop loss orders is essential. These orders automatically close your position at a predetermined price, helping to limit potential losses. A common practice is to set the stop loss level between 1% to 3% below your purchase price. For example, if you buy a stock at rupees 300 per share, a 2% stop loss would be triggered at rupees 294, helping you limit your potential losses.
Those are great tips. But what about diversification? How does it play into leveraging?
Diversification is key when using leverage. Avoid putting all your capital into a single trade. By spreading your investments across different assets or strategies, you can mitigate risk. This way, a poor performing position won't have a devastating impact on your overall portfolio. That will ensure that underperformance in one sector will not hamper your entire strategy, saving you from a debt trap because of the leverage used.
But setting realistic profit targets is also important, right?
Exactly. When trading with leverage, it's crucial to set achievable profit targets. This helps maintain a disciplined trading strategy and ensures that you lock in profits before market reversals occur. Ideally, you should aim for a risk-reward ratio that justifies the leverage being used.
Well, that sounds interesting. Anything more you want to add?
Leverage can amplify not just profits but also transaction costs. Frequent trading incurs various costs such as brokerage fees and taxes. It's vital to ensure that your profit margins exceed these costs to maintain a sustainable trading strategy. Keeping a close eye on transaction costs will help you assess the effectiveness of your leveraged trades. Therefore, monitoring transaction costs becomes a vital part of your trading strategy.
Wow. Thanks, Kushal, for sharing these insights on leveraging in FNO trading. It's clear that while leverage can enhance returns, it carries equal risks too and requires careful management and strategy.
Thank you for having me. That wraps up today's episode. Join us next time for more discussions on trading strategies and financial insights.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.